New data out this morning showing that new home construction slipped in March. Housing starts falling 14.7% on a monthly basis, while building permits fell just over 4% from the month prior. Now, this comes as homebuilder confidence remained flat in April amid rising mortgage rates. Joining us now, we want to bring in Brad Case. He's Middleburg Community's chief economist. Brad, it's great to have you here on set. So, interesting numbers coming out on the housing front today. What does this tell you? Is it a bit surprising? And I guess, what does this tell you about maybe this recovery that we've seen losing a bit of steam?
Yeah, it was surprising to me. I expected the starts numbers to be up. The permits, I wasn't surprised by the fact that they were down at all. What we've seen in new residential construction is an increase in the employment of people working on these projects, and that's why I expected a bump up in starts. We didn't see that. More generally, what we've seen over the past few years since the COVID pandemic started was first a huge surge in demand, and then a huge surge in supply, and then that is pretty much over. What surprised me this morning was that it was such an emphatic, this is over. I expected it to be just a more moderate pace of construction from here on out.
What does that set up for the spring buying season that we're expecting to see really commence?
Well, I think it's difficult for the single-family owner-occupied market because so many people don't want to get out of their current mortgage because they plan to buy a different house and they'll be moving into a different mortgage. So it's going to take a long time for the single family market to get out of that. For companies like mine that are engaged in the rental housing side of the market, it's actually good news because it means that people who are trying to make the choice between buying and renting their next place to live are, they're not finding what they want in the owner-occupied market. So they're very happy being in the rental part of the market.
But let's talk about the rental side of the market, specifically the rental component of the CPI print, because it has been improving, coming down just a bit, clearly not at the rate that the Fed would like to see. What does that then do? I guess, how do you think the Fed should look at this number, is looking at this number, and what does it ultimately tell us, if anything, about maybe inflationary pressures to the upside still?
Yeah, so the most important thing to keep in mind is the Fed is not fooled by the fact that the CPI rent component or shelter component is coming down so slowly. It has been coming down more slowly than I and other people expected, and that is something for the Fed to pay attention to. What that means is that the demand for housing is stronger than anyone thought it would be. That's both the owner-occupied, but as we were saying, there's kind of a plug in that part of the market, and it's also the rental side of the market. The Fed is not going to make their decisions based on the shelter component of the CPI. They're going to make their decisions based on what's actually happening out in the market for rents. And what happened is after a big surge because of that demand surge during COVID, rent growth over the past year has been very close to zero. It's actually, again, been a little bit stronger than we thought it was because demand has been stronger than we expected it to be. So that's actually, that's of course good news for anybody who's providing housing, whether it's rental or owner. But the CPI rent component is not going to drive the Fed's interest rate decisions.
What about capacity that we're expecting to be brought online? When is that going to put a dent, perhaps, in some of the prices and the stickier than expected, perhaps, shelter inflation and costs there?
Yeah, I mean, the capacity or the supply it has already had an effect on pricing. It's just that in the owner-occupied part of the market, you don't observe changes in pricing until people sell, and they don't want to sell because then they have to buy in at a much higher interest rate. And so the values have gone down. It's just not revealed because there have been so few sales. In the rental side of the market, you don't have that plug stopping the activity. So you do see the rents, the rent growth having actually dropped down to very close to zero, depending on where you're looking and which data source you're looking at.
But I want to take a step back here and not just talk about housing, but really what we're seeing more broadly play out in the economy, because you've spent several years at the Fed. I'm curious what you make of the latest econ data that we are getting out here, the fact that the economy has remained so resilient, and then weigh into this debate that is starting to gain a bit of steam here, just in terms of the fact that maybe there's higher probability now of a no landing scenario. Do you agree with that, and why?
Well, yeah, in a sense, so I started saying this more than 2 years ago. People more than 2 years ago started calling a recession, and I was looking at the data and saying, right, a recession could happen, but the data don't suggest it yet. And so I kept on saying, I will let you know when the data show a recession coming, and it just never came. So the probability of recession, according to my model, which I will be updating later this morning, is still elevated. It's at about 15%. Okay, but that's nowhere near what people were saying. Now, in terms of no landing versus soft landing, in a sense, they're really the same thing. And a few days ago, one of my colleagues was saying, if we do a soft landing, what will it look like? This is what it'll look like. And what it'll look like is some indicator will come down that's weaker than expected, like this morning's construction data. And then another indicator will come down that's stronger than expected, like yesterday's retail sales data. We're going to continue to have those signals. And what you have to keep in mind is 1 month of data is not going to tell you very much, no matter what the indicator is. When I am looking at data, typically I'm looking at progressions in 3-month moving averages, just to get away from, number one, the sort of random movements that come from the fact that we're using survey data, and also from the corrections that we know are always going to happen in both directions.
Brad Case, Middleburg Community's Chief Economist. Brad, great to see you here in person.
Thank you very much. I'm glad to be here.